Jim, the Bank of Canada lowered their interest rates today, and their reasoning gave compelling support to your currency wars argument. Here's what the official statement said. The Bank of Canada today announced that it is lowering its target for the overnight rate by 1/4 of 1 percentage point to 3/4%. The bank rate is correspondingly 1%, and the deposit rate is 0.5%. This decision is in response to the recent sharp drop in oil prices, which will be negative for growth and underlying inflation in Canada. Oil's sharp decline in the past 6 months is expected to boost global economic growth, especially in the United States, while widening the divergences among economies. So the Canadian dollar hit 6-year lows against the U.S. dollar as a result of this. What's your overall impression of this move?
Well, I agree with you, Ed. This is Currency Wars 101. I mean, the idea is we'll lower the interest rate to sort of stimulate the economy. The Canadian economy may need some stimulus because of, declining oil prices are good for consumers around the world. But if you're a major producer, such as Canada, or if you have a lot of exploration and development, a lot of infrastructure, capital expenditure, it could actually be very bad in the sense that there'll be a lot of layoffs in the oil patch. So they want to stimulate their economy. The only problem is cutting interest rates doesn't stimulate the economy. It doesn't even stimulate exports that much. All you get is inflation. So maybe that's what Canada's hoping for. The whole world is suffering either strong disinflation or borderline deflation. A lot of parts of the world have sort of lapsed into deflation. We're seeing declining growth in China, it's close to negative growth in Japan. Europe, I think the U.S. is slowing down significantly. Canada is as well. So, Canada's trying to give their economy a little monetary boost. Of course, the real problem is structural. They'd be better off thinking about things like cutting taxes and doing some other structural things that might be a little bit better for it. But the problem is, in currency wars, is that all you're doing is stealing growth from your neighbors. So maybe Canada will get a little bump out of this, but it comes at the expense of someone else. It's a zero-sum game, and the someone else really for the whole world right now is the United States. So I actually spent quite a bit of time in Canada. I have some family there. So I love a cheap loonie, go up there. I feel like everything's 30% off. So, it might give them a little pop, but at the end of the day, it just steals it from the United States.
Well, now, Stephen Poloz, who's the head of the Bank of Canada, he said in the press conference after the cut that the move was determined by concerns about undershooting the BOC's inflation target. Currency weakness was not an aim of the cut. But, Jim, isn't the fact that we're seeing economic weakness everywhere and monetary accommodation as a response a de facto currency war, whether or not that's the currency is the central target?
That's absolutely right. When the official says that, what we're trying to do is, kind of hit our inflation target, well, okay, where's the inflation going to come from? Well, one of the places it comes from is imports. You import inflation with a cheaper currency. If you cheapen your currency, you've got to pay more for everything you buy abroad. So, look at Canadian imports, electronics, manufactured goods, foreign cars, things from around the world. The Canada imports, so they'll all get a little bit more expensive. So you are importing inflation. He doesn't want to call it a currency war. They don't want to say that, they're stealing growth from their trading partners, which is what they are. But when they say we're trying to hit our inflation target, that's actually correct. But implicit in that is the way you do it, or the way you try to do it, is by importing inflation through a cheaper currency. So it is currency wars.
Now, Poloz also said that the U.S. will be bolstered by the drop in oil prices and Canada will be hurt by it. He then makes it seem as if that means policy divergence, which I assume he thinks is a bad thing. Given the huge the shale oil play in the United States, do you buy into that line of argument?
It's a really complicated argument, Ed, but let me just take you and the viewers through a couple of the factors here. Look, the first derivative is lower oil prices means lower gas at the tank. So that's good. No one really disputes that. So if I use 100 gallons of gas a week and it goes from $4 to $2, that's putting $200 in my pocket or any consumer's pocket. That's a good thing. By the way, the governments actually don't like that because they can't tax it. It's like getting a $200 a week raise that the government can't tax because your tax bill is the same. But now the assumption is everyone will go out and spend it. Well, maybe, maybe not. I mean, there's a lot of deleveraging going on. People might use that money to, pay off credit cards, car loans, student loans, mortgages. There's a lot of debt out there. So first of all, people might just use the extra money to deleverage, just because they have it doesn't necessarily mean they spend it. So that's the sort of the first order effects. But the second order effects are a lot more disturbing. First of all, to the extent that economic growth has been driven by jobs in the oil sector, fracking in particular, parts of the country have been booming. These are very high-paying jobs, by the way. These are not fast food jobs. Not that there's anything wrong with working, fast food place. There's dignity in all work, but these oil patch jobs are relatively high-paying, so we'll start to lose those. But also capital expenditures. Corporations are slashing their capex for 2015. Not all of that's in the market, but that's been going on really since November. And then behind it all is the bad debt. I mean, there are trillions of dollars of bonds, a lot of them junk bonds that have been issued. I mean, where did all the oil come from? Well, it came from fracking to a great extent. Where did that come from? Well, it came from exploration and development that had to be paid for. A lot of it was with junk bonds. Now, where are those junk bonds? Well, a lot of them are in bond funds. A lot of them might be in Americans' 401ks, and they don't even know it. Well, a lot of that was priced with oil in the expectation that oil would be between 80 and maybe at the high end $130 a barrel. With oil at 45, even if it went back up to 50 or 60, a lot of those projects are non-economic. A lot of those bonds are going to default. So you're looking at several $1 trillion potentially of bond losses. That's going to hit the banks. It's going to hit people's 401ks. So yeah, first order effect is good. A little more money in your pocket, although don't be so sure people are going to spend it. But the second and third order effects could be devastating, which is lost jobs, lost capex, and a tsunami of bad debt, bigger than the subprime mortgage crisis.
Interesting that you think it could be that big. I'd love to talk about this a little bit more, but there's some breaking news that came out on Wednesday about the Wall Street Journal reporting that the ECB Executive Board Council, it's already decided to recommend that the ECB buy 50 billion euros of Eurozone sovereign bonds every year, or every month for at least a year. Will the ECB actually do QE this week, and how will it be structured?
Well, very good question. We call it QE. They actually don't call it QE. They've got these, targeted long-term refinancing operations and outright monetary transactions. They've got a whole bunch of a whole alphabet soup of names for the programs. But Ed, you put your finger on the most important point. The number, so you take 50 billion euros times 12 months, you get 600 billion euros. It's, a somewhat larger amount in dollars. I mean, it sounds impressive, but it's not as important as the details, and you're right about the details. First of all, this was sort of a preliminary green light. We'll find out Thursday what they're actually doing, but even then we won't know because they'll give some high-level guidance, but then there are all these technical rules that they have to write. In Europe, the legal system is very much more rule-oriented than the U.S. We have sort of broad discretion to do a lot of things. In Europe, they want to write everything down. So they've got to write the rule book on that. It might take at least days, possibly weeks, to put that out there. So we won't know exactly how they're going to implement it. And they have a whole lot of choices. I mean, for example, do they want to buy them themselves? That is the European Central Bank. Do they want the national central banks? There's still central banks in all these countries. There's a central bank of Greece and, the Deutsche Bundesbank, Central Bank of Germany, Italy, and so forth. Do they want those so-called NCBs, national central banks, to buy them, which puts some of the credit risk at the national level? Or will the ECB buy them directly? Will they buy everything? Are they going to be sensitive to credit ratings? Buy some and not others? And then are they going to put caps, for example, if there's only a certain amount of bonds out there? Will they say, well, we won't buy more than 10% of a Portuguese issue? I don't want to get too down in the weeds, but my point is that how you implement this is really important. And here's the takeaway. Looking at all that detail, it kind of makes your head hurt a little bit, but looking at all that detail will signal whether there's been any relaxation in German intransigence. In other words, Germany's, they might be on board some version of this with lots and lots of conditions, but on the other hand, they might just sort of give the ECB a green light. I actually doubt the latter. I think there'll be plenty of conditions, but looking at those details will signal how many degrees of freedom the Germans are actually giving to the ECB, and that'll say something about the future of monetary policy and the future of so-called QE in Europe. So yeah, kind of a big deal. I think the market has priced this in, but let's look at the details.
Going back to, let's say, last week and what the Swiss did, do you, and that's obviously connected to what Europe's doing now, do you think the Swiss should have dropped their Euro-Swiss currency floor?
Well, I think they never should have had it in the first place, but that's just my own view. Look, whenever you have to peg something, it tells you you're fighting the market, because if the market wanted to go to a certain level, it would go to that level. If you're pegging it, it tells you that you're fighting the market. And central banks, hedge funds almost always lose. When you're fighting the whole market, you almost always lose. So I look at what the Swiss National Bank did. It's almost like a leveraged hedge fund hitting a stop and just saying, hey, I hit the level, I got to get out of the trade. They were going to end up owning all the euros in the world. I mean, by the way, the Swiss actions for the last 3 years connect to the European Central Bank QE we were just talking about, because a lot of the benefit of the ease is already in. I mean, look at European yield curves. So some of them have negative nominal rates. Forget about negative real rates, which are not even close to that, but they have negative nominal rates, negative yields to maturity on a lot of these bonds. How much flatter can the yield curve be? A little bit. It can come down, but when you start seeing Portuguese and Spanish and Italian bonds, like 90 basis points. They're not there yet, but they could be heading in that direction. I think they probably are. I mean, a lot of the ease has been done because when the Swiss National Bank was defending the peg, the way they were doing it, they were printing Swiss francs and buying euros. Well, once they get the euros, what do they do with them? Well, they were going out buying European debt. So in some ways, the quantitative easing already happened, and it showed up in the yield curve. So how much more impact can the ECB actually have? By the way, a lot of this is for show. I mean, I don't think any of this really monetary ease doesn't stimulate economies. No one's yet explained to me how printing money can create jobs. You stimulate your economy with structural changes, fiscal policy, education, technology, innovation, trade policy. There are a lot of ways to help your economy, but printing money isn't one of them. So in some ways, this is all for show.
It's interesting that you mentioned that the Swiss move already started the QE. I want to ask you a question about the Swiss National Bank, because they went into the currency floor move knowing that they had to exit the policy at some point in time. They had to assume that when they did exit, it was going to be when it's convenient for them, when there was no longer any upward pressure on the Swiss franc. But that's exactly not what happened. They ended the regime at the worst possible time. So do you think that this has been damaging for their credibility and the credibility of central banks more generally?
Absolutely. I think, first of all, the credibility of the Swiss National Bank is in shreds because they lied to their people. They came out, remember, November 30th, there was that referendum to put Switzerland back. I'll call it a modified gold standard. They were going to require the National Bank, Swiss National Bank, to hold a certain percentage of the reserves or the amount of currency issued in gold to repatriate their physical gold from New York, or sorry, not New York, from it's actually in a lot of it's in Canada, and basically to buy more gold on a going forward basis. Now, the Swiss National Bank said to the people of Switzerland, vote no. We want you to vote no on that. The reason is if you vote yes, we're going to have to break the peg, and we don't want to break the peg. But then they broke the peg. So in effect, they lied to people about the referendum, got past it. Even as recently as 2 days before they broke the peg, they said, we're irrevocably committed to this, we're not going to do it, and they did it anyway. So they lied to their own people, they lied to the markets, their credibility is in shreds. But I think you make a good point, Ed, that this says something about the credibility of central banks in general. They're all manipulating markets. Manipulation, by definition, involves some kind of fraud because you can't tell people what you're actually doing. I think it's true of all the central banks, all the major central banks around the world in different ways. So yeah, I think it's very damaging.
Well, now the currency speculators are onto the Danish krona. The Danes, they've pegged their currency to the euro for some 30 years. Or the euro's predecessors. The interesting bit is that if you look at the policy rate, since about 2011, the Danish policy rate has needed to be lower than the ECB rate to keep the peg in place, whereas the opposite was actually true. So it sounds to me like the peg will be under pressure for a long time to come. What's your view on the Danes pegging to the euro despite the fact that they don't even want to be a part of the euro? Does that make any sense at all?
Well, I mean, they don't want to have the euro as their currency, but they're very tightly linked to the rest of Europe, and having a peg is some way to take exchange rate volatility. I don't know why they just don't join the euro. That would be the most sensible policy. But it's a smaller economy than Switzerland in some ways, a little bit less dependent on exports. They've got swap lines with the ECB, so if they need euros, they can they can get them easily. So. It all depends what the market wants to do. I mean, if the market puts enough pressure on any artificial peg, they will break it eventually. But I don't think we're quite seeing that kind of pressure we saw. The problem with Switzerland could have maintained the peg. It's not as if some hedge fund was putting pressure on the Swiss National Bank. They got out of it themselves because they realized with the euro weakening, they were going to have to buy every euro in the world Eventually, it was going to break. It was, as you point out, it would break at the worst possible time, and they'd have losses. You actually, I mean, they are a bank. They do have a balance sheet and income statement, and at least on a mark-to-market basis, they've suffered enormous losses. I mean, kind of getting back to Switzerland for a minute. I mean, they lost, tens of billions. Actually, I think upwards of 50 billion or more on the euro peg, and then they lost an equally large amount selling gold. You go back, Switzerland sold thousands of tons of gold over the last 14 years, most of it at much lower levels than gold is today. Gold's, around 1,300, give or take. They sold a lot of gold at $800, $900, $1,000 an ounce. So when you combine their losses on the euro with their losses on the gold sales, they've done nothing but, sort of lose money for their stockholders for a long time. So that's gross incompetence. I think they just wanted to get out of that business completely. Again, Denmark's a little different case, but at the end of the day, no, you can't stand up to the market. You can temporarily, but not in the long run.
Jim, why is the U.S. dollar so strong right now?
Well, this is in anticipation of policy. The whole world is set up for an interest rate increase later this year. Now, I don't see it. I don't think the Fed's going to raise interest rates in 2015. If they do, I mean, they could, but if they do, it'll be a disaster. It'll throw the U.S. economy into a very severe recession. But all my conversations with Fed officials confirm, I think, what we know, which is that they are data dependent. When they say they're data dependent, they actually do mean that. And so the difference between the Fed, in effect, telling the market they're going to raise rates and someone like me looking at it saying they can't possibly raise rates is a different view on the data. But that comes in, we're all projecting, right? We all have our economic models. But the Fed has the worst forecasting record of any major institution I can think of, worse than Wall Street, believe it or not, and worse than private analysts. So when the Fed says they see enough growth to justify a rate increase, that almost certainly means that the growth is not there because their models are consistently wrong. So basically, the world is set up for a rate increase, and the world is set up for QE in Europe. So you look at that, and we already have QE, extreme QE in Japan. So you look at that, you're a global investor, you've got to allocate your capital somewhere. You say, if I come into the U.S. markets, looks like I'm going to get a little bit of a yield. If I go into these other markets, I'm going to get negative yields, so I'll buy U.S. dollars. And so it's just capital inflows, nothing to do with trade. It basically is capital inflows driven by the expectation of an interest rate differential. Now, what gets interesting is that if I'm right about the economy later this year, the Fed's finally going to kind of wake up and smell the coffee and see how weak it is. And again, based on my conversations with Fed officials, if the data comes in weak, they will not raise rates. They think it's going to come in strong. That's the difference of opinion. But if it comes in weak, they won't raise rates. And there's probably a lot less than meets the eye in terms of ECB QE. So by April or May, we may be at a point where it appears the Fed's not going to raise rates, and it appears that Europe is not as easy as people thought. And this whole trade could flip. I mean, all of a sudden, the strong dollar could go to being a weaker dollar, and the euro can rally. I think we're kind of at the extremes of the range right now, and this could turn around very quickly. But that's also characteristic of currency wars. Remember in 2011, the whole world was complaining about the weak dollar. Today, the whole world's complaining about the strong dollar. Well, it's a seesaw. It goes back and forth like this because the currency wars don't have a logical resolution until the system collapses or you have some kind of international monetary conference like the Plaza Accord in 1985. So I don't see that on the horizon. So the seesaw is going to keep going back and forth. So I think, don't be surprised if later this year we see this, the dollar weaken and the euro strengthen, based on the Fed not raising rates and Europe not doing as much as people expect.
Well, we will see. And you mentioned the good word about data dependency because Fed Chair Yellen, she says, yes, the Fed's policy decisions are data dependent. What do you think the most important data points are, and how will they develop in this quarter and the next quarter that's going to determine what the Fed's actual reaction function is?
Well, there are a number of them, of course, and Janet Yellen has a lot of things on her dashboard, and they're looking at the unemployment rate, which has obviously come down quite a bit, but they're also looking at labor force participation, which continues very close to historic lows. They're looking at inflation, deflation, but obviously we're going to get deflation. We've already had some, and we're going to get more. But the Fed tends to factor out oil. They look at core versus non-core because they believe that the energy prices are sort of mean reverting. They're very volatile, and when they go up a lot, they don't read too much into it. When they go down a lot, they don't read too much into it because actually, historically, if you look at the data, it does, the energy price does sort of revert back to the mean of prices in general. So Historically, there's some basis for factoring it out, but it may be different this time because what's going on is not market-driven, it's geopolitical. Saudi Arabia is trying to poke a stick in Iran's eye. They're trying to poke a stick in Russia's eye over their support of Syria. They're trying to put the frackers out of business. So Saudi Arabia has a lot of geopolitical, market share, non-economic reasons for doing what they're doing to keep the price of oil low, which means it may stay there, contrary to what the Fed models say. Again, back to the fact if you have bad models, you're going to get bad results and bad policy. So again, it may be the case that by the middle of this year, the oil price does not go back up to 100. I don't expect that. And if the Fed model does, they could be wrong again. Now, but if you ask me to name one thing that Janet Yellen is looking at, it's real wages. Because remember, they have a dual mandate, price stability and employment, creating maximum employment. That's the dual mandate. Sometimes they're in conflict and they have to pick one over the other. Right now, they're focused more on employment, not as worried about inflation. But that could switch. If labor market conditions tighten and inflation starts to come in, then Yellen's going to pivot away from employment over to inflation. That's when she would raise rates. How would she know if that's happening? Well, real wages. When you see real wages go up, it means labor market conditions are tightening, workers can demand a raise, and the raise has implications for inflation. So that's the number one thing on her dashboard. But guess what? Real wages are flat to down. They're not going up. So that's one more reason I don't expect a rate increase. I think Yellen will see it the same way.